So you want to generate passive income via covered call ETFs while getting some capital appreciation. Well, look no further than the Hamilton Enhanced Multi-Sector Covered Call ETF, also known as HDIV. Now, HDIV is a very special ETF because it's actually an ETF of ETFs. There are multiple ETFs within this one overarching structure of an ETF, which brings you as an investor even more diversification. Now, my name is Christopher Bell. I am a boglehead investor where I believe you should buy a total market index and minimize the complexity of your portfolio. But I also understand that people have different investment objectives. They have different strategies that they want to execute depending on their stage of life and their desired goals. So in this video, I'm going to give you my honest opinion about the Hamilton Enhanced Multi-Sector Covered Call ETF. And why I personally am not a fan doesn't mean it's a horrible ETF that you should never invest in, but I'm going to tell you specifically why I am not a fan of this ETF. So the first thing that I see is a covered call ETF. What is a covered call? Basically, you own a bunch of stocks and then you enter into contracts with another party where you agree that if the stocks you own go up to a certain price, you are obligated to sell those stocks to the other party. In exchange, that party pays you a premium. So you are generating income. You are trading capital appreciation, but you are receiving income. So if you think about it, if a stock was to go up massively, let's say you entered into this contract and you had 100 shares of Apple stock, and Apple stock went up massively, insanely high, very quickly, out of nowhere, unexpected. And you had this contract where you were receiving premium in exchange for the obligation to sell your shares. Well, guess what? You would be exercised and you would lose your shares. That is something you have to consider. And that means that you are actually limited in your upside potential. That is the whole concept behind covered calls. Income now, but you get limited capital appreciation. However, you can actually do well in a bear market because as stocks are going down, you're not being exercised, but you're still generating that covered call premium. So that's something to keep in mind as well. So let's dive into the ETF because I've been rambling long enough. HDIV has outperformed the S&P TSX 60 by 2.27% annualized since inception. Now, I look at that statement and I always question statements like this. A covered call ETF has outperformed a broadly diversified Canadian index, it looks like. How did that happen? Well, we can see that outperformance has been only over less than 2 years, from July 19th, 2021 to February 28th, 2023. This is a meaningless statement. Number one, past performance does not indicate future performance, and I'm sure these people know that. And number two, that's such a short time frame that anything can outperform anything. Dogecoin outperformed the S&P 500 over a certain period of time. You could selectively pick anything and say, this asset has outperformed that asset. And you would be right. But does that mean this is a good investment? It's up to you. But looking at this, it's like, okay, why is that statement there? It's the first thing on there. Interesting. Yield of 10.47% with monthly distributions. Now, here is where people get hooked in. Okay, because they say, oh, if I just put a ton of money into this, I will get a 10.47% annual yield, basically, and I'll get monthly income, kind of like a salary, kind of like a paycheck, right? Well, what people don't consider is total return. Total return is a combination of income plus capital appreciation. You could have a crazy high yield, but your stock price or your ETF could go down in price massively. This happens with tons of these covered call ETFs where they have these amazing high yields and you think you're making 10%, but if the stock price goes down or the ETF goes down by 10% and then you get 10% income, you've actually made nothing. Okay, that's something you need to consider. So you need to look at the total return of these things. So it sounds like so far this thing has done pretty well. But you got to remember, we're in a bear market. Of course, covered call ETFs do better in a bear market. What happens when we get into the next bull market? What do you think is going to potentially happen? Is this thing going to implode? I don't know. Is it going to underperform a broadly diversified index that doesn't have covered calls? Most likely, because Covered calls limit your upside. I'm just saying. Portfolio of primarily sector covered call ETFs with a sector mix broadly similar to the S&P TSX 60. Okay, so diversification. And then they have modest cash leverage of 25% to enhance yield and growth potential. Now, when I see the word leverage, that automatically terrifies me because leverage means you're borrowing money. When you borrow money to do anything in investing, you're taking on extra risks because if you have a terrible trade or you have a terrible investment, not only will your investment go to zero, but you'll actually be in the hole. If I were to buy the S&P 500 and all stocks went to zero, what's the worst that I lose? It went to zero. Okay, it went to zero. Big deal. What if I had leverage? What if I borrowed money? Well, the index could go to zero, then I could still owe money on top of that. So your losses are actually greater. You could have greater losses. So there's a risk there with leverage. But then again, leverage can amplify returns, but it can also amplify losses. That's something you need to keep in mind. So you basically have to trust these fund managers to do well with this leverage and make sure that they don't make horrible investment decisions. That's another risk that you have to factor in. Now, they may be the best managers in the world. I'm not saying they're not, okay? But there is the risk with using leverage that this thing could blow up in your face, okay? So let's see. They have attractive monthly income. Great for now. Sector diversification. Increased growth potential versus individual covered call ETFs. I'm not sure why. Higher yielding alternative versus broad-based index ETFs and individual covered call strategies. So yes, you probably do get a higher yield. Now, if we go down and we look at some other stuff, right? So here's the performance. Okay, I mean, it's gone up. I mean, it's definitely gone up. Now, they got a high yield. They've outperformed the TSX. Like I said, that's meaningless. We can see some of the sector contributions, financials, utilities, healthcare. Basically, whoa, that's interesting, gold and energy. Gold, okay. But a lot of these sectors are known for their dividends. Now, here's what this thing is like. This is too complex for me. This thing is composed of like 8 other ETFs. 8 other ETFs. That's a lot of ETFs. Like, this thing is, how do you really analyze this thing? How do you understand what's really going on in this thing when you're just buying a basket of other ETFs? Okay, if you really wanted to do your due diligence, you would have to go and research all of these. All of these, because these are all different ETFs, and they're all at significant enough weights, except for this thing right here, that you should probably understand what's going on. I mean, they're pretty apparent up front what they are: energy, financials, blah, 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 blah. But you still need to look at each fund and see if there's potential problems going on, which makes it more complex, okay? So the last thing I don't like is the management fee. Look at this, 0.65%. Now, if you wanted to buy a S&P TSX 60 index, okay, and I'm an American. I don't invest in, I mean, I do through VT, but I don't typically, like, watch the Canadian stock market, okay? But here, this looks like you know, basically kind of like an S&P 500 equivalent is what it seems like to me. Look at the management fee here, 0.07, okay? Management expense ratio, 0.04. Insanely cheaper. You could just buy an index that is much less complex, that doesn't reduce your upside gains, and you would pay a much lower expense ratio. But like I said, if there's a bear market, you know, this thing may do better. So that's something to keep in mind. Now, another thing that a lot of people always have questions about, and I'm just going to tell you my understanding of how this works, is return of capital. What is return of capital? Now, I work in tax in the United States, so I don't know if Canada's different, okay? But I know when funds have distributions, some of them are taxable, dividends, capital gains, at least in the United States, foreign income, I guess this is American income, but then you have return of capital. Now, how I've been trained is return of capital is not a taxable distribution because it is basically returning part of your principal back to you. So what it does is it lowers your cost basis. Your cost basis is just the price that you paid to invest in something. Let's say if you buy a stock for $10, your cost basis is $10. You know, and maybe you paid commissions, whatever. But basically, whatever you pay for something is your cost basis. When you get a return of capital, it reduces your cost basis. Now, up front, this is not a taxable event. But in the long run, when you go ahead and sell the shares, you're actually going to pay a higher, basically deferred capital gain because you've lowered your basis over time. That's what return of capital is. So if you see something that's paying out a bunch of return of capital, those aren't real dividends. That's not a real dividend. It's a fake dividend. Look at this. Return of capital is a payment or return received from an investment that is not considered a taxable event. If it was income, trust me, the government would probably tax it, okay? Capital is returned, for example, on retirement accounts and permanent life insurance policies. Regular investment accounts return gains first. Investments are composed of a principal that should generate a return. This amount is the cost basis. Return of capital is a return of the principal only, what you put into it, and is not any gain or loss as a result of the investment. So when you see return of capital, I mean, what is it? It's just basically returning your initial investment and reducing your cost basis. That's all it is. Wow, it's a dividend, right? No, it's not. It's a fake dividend. So just something to keep in mind. Now, could this thing go to the moon and be amazing and perfect and maybe it's appropriate for some people? Absolutely, okay? But you got to understand the risk. You got to understand that just because it outperformed the TSX 60 may not be indicative of the future, especially because we're in a bear market right now. Dividend yields can always change. You got to consider total return. You got to realize this thing is an insanely complex product with a pretty decently high expense ratio. There's a lot of things you have to consider when you invest in this thing, okay? So I just wanted to expose this ETF for you. Maybe this is a great choice. I don't know. Maybe Adriano Sterioneri is a genius. Or maybe he's a shill. But that's kind of my thoughts. Hope you enjoyed the video. Hope you learned something. Talk to you later.